Whether you talk to a day trader, a real estate investor, or a productivity nerd, they're all obsessed with the 1% rule. This single rule in finance completely changes flavor depending on who you talk to. But they're all talking about three completely different things. Let's break down exactly how this one rule runs the financial world and how you can use all three versions to build wealth. First up, Trader's Lifeline. If you ever blown up an account or lost money on a bad investment, it's probably because you didn't know about this. Professional risk managers use the 1% rule to ensure they literally cannot go broke. The rule is simple. You never risk more than 1% of your total liquid capital on a single trade. Notice I said risk, not trade. If you have a $10,000 portfolio, 1% is 100 bucks. This doesn't mean you only buy $100 worth of stock. This means if your position moves against you, your hard stop loss cuts the trade the exact moment your loss hits $100. You could lose 10 trades in one row and still have 99% of your capital intact. It removes the emotion and keeps you in the game. Now let's say you hate stocks and want to buy property. If you jump over to real estate, the 1% rule shifts entirely. Here, it's used as a brutal filtering tool to instantly see if a rental property will actually generate positive cash flow or just bleed you dry. Under this rule, a property needs to bring in at least 1% of its total purchase price in gross monthly rent. So if you're looking at a house that costs $300,000, it needs to rent out for $3,000 a month to pass the test. Now let's be honest, in today's housing market, finding a pure 1% deal is incredibly rare unless you're looking at a specific multifamily units or fast-growing mid-market neighborhoods. But investors still use it as a North Star. If a property is pulling in 0.5% of its value in rent, the numbers usually won't work out after you factor in mortgages, insurance, and maintenance. Finally, there is the psychological version, made famous by James Clear, the 1% habit rule. This states that if you can improve your financial habits, your skills, or your business by just 1% every single day, the compounding effect over a year is staggering. Mathematically, if you get 1% better every day for 365 days, you don't just get 365% better. Because of the compounding interest, you get 37 times better by the end of the year. Conversely, if you get 1% worse or let your habits slip by 1% every day, you drift almost all the way down to absolute zero. So whether you're setting a stop loss on a trade play, analyzing a rental unit, or just trying to save an extra 20 bucks a week, the 1% rule is the ultimate framework. Protect your downside by 1%, filter your investments with it, and let compounding do the heavy lifting.